Hit it.
It's Friday, August 9th, 2024, episode 245. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, Marko Papic from BCA Research joins us to share how he incorporates geopolitics into his investment framework and why everyone is doing it backwards. Then Patrick tries to make sense of these topsy-turvy markets and talking charts.
A couple of announcements. Last episode, we went cameras on for the YouTube show. So anyone listening to the podcast and wants to check it out, go to the Market Huddle YouTube channel. Also, it's become increasingly a rare event that Kevin and I are in the same city. So while I'm here in Toronto, we decided to have a little Market Huddle piss up. So on Thursday, August 15th, we're going to have a few brewskis at the Rec Room downtown Toronto by the CN Tower. All listeners that want to swing by and join us for a beer, welcome. No RSVP needed. Just swing by and say hello. So, we're going to drink some
Well, you know
beers.
what I realized, Patrick?
What?
You didn't put a time on this.
7 p.m.
There we go.
Jesus, thank you for clarifying that. 7 p.m. on Thursday, August 15th, at the Rec Room across from the CN Tower. All right, Danny, hop on here, buddy. And what beer am I drinking today?
You are drinking cream ale from Clear Lake Brewing Co., which is in Canada. It says they use honey to ferment. It dries out the beer, providing high alcohol content. Shocker. This leaving a crisp finish with no residual sweetness.
Oh, 5.4%. That's not crazy high. That's
Anyway, think, Patrick,
it's good. It's a nice cream ale.
All right.
We'll talk about the end. So, Kev, give us some disclaimer here, buddy.
Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include bond yield bloating.
I've had that.
Recessionary reflux and the bear market blues.
All right, let's get Marko on.
All right, it's our pleasure to welcome back to the show an old friend, Marko Papic, who is now no longer at Clock Tower. He is now the chief strategist at BCA Research. Marko, thanks for making time for us.
Oh, it's a pleasure. Thank you for having me. It's always fun.
It is always fun. I always like talking to my fellow Canadian that I was just looking at your book here. You sent me this book, and I noticed that you signed it. And when you signed it, you actually were just digging in. I see it says from Santa Monica. And I feel like that was you just kind of rubbing it in that, a Canadian that got out and went somewhere nice. So you've had a recent change in terms of your career path. You went back to BCA. Why don't you talk a little bit about kind of why you did that? What's changed in your time at Clock Tower?
I learned a lot on the buy side, and it was great working with Steve Drobny. We did a lot of cool stuff. We seeded some great macro hedge funds, which taught me a lot, not just about, markets in the buy side, but also what it takes to start an investment firm and what it takes to create an asset manager from scratch, which is a lot. I also found out that I'm really, really good at macro research, and that's really my wheelhouse. And so, I was delivering research to our LPs, and then expanded that to some clients, and that went really, really well. And so I decided to sort of strike it out on my own. And BCA Research came and said, "Hey, listen, here's an alternative to going on your own." And so I really am glad to come home. BCA Research is where I started my career in 2011. I started the Geopolitical strategy there, which is a product run by my dear friend, Matt Kirkin, that focuses on geopolitics from the investment perspective. And my new product that I'm launching at BCA Research really focuses on investing from a geopolitical perspective. So you should think of what I do at the firm as a global macro product whose methodological bias is politics and geopolitics. I joke with clients, like the little kid from Sixth Sense. You know that movie with Bruce Willis, the little kid who goes around and always says, like, I see dead people everywhere. Right. Where I see politics everywhere. So that's my kind of special sauce.
All right. So, Steve Drobny I am forever indebted to him because he actually wrote that book, Inside the House of Money. And I got to meet Jim Leitner, who I've come to know really well. And I think it's just one of the best guys around. And I am forever indebted because without Steve's book, I would have never met Jim. And I'm sure it's going to be kind of like mixed emotions as you leave there, but head back to this new, your old shop. Luckily, I understand that you don't have to go back to Montreal and you get to stay in Santa Monica. Is that correct?
Well, I live on an airplane.
Oh,
so the truth is that it doesn't really matter where I live, but I intend to spend a lot of time in Montreal. I mean, I have still a place in Montreal. I love Montreal. And so,
okay.
I'm definitely Canadian, and I like to bounce around Canada.
Yeah, you're like a true Canadian. You go to the States in the winter, the bad months. Okay. All right. Let's talk about your new product and how you view stuff. We made some slides here. So Daniel's going to start it off. So you mentioned it already. You've started a new product called the GeoMacro Beta Report. What is GeoMacro? And I think one of the things that we'll just start with is the thing that I know you best for is this idea that when it comes to geopolitics in terms of the short run, oftentimes the move is to fade it. So let's go to the first chart here and you can explain to us what this means in kind of how you think about geopolitics in terms of how it affects the markets.
Yeah, a lot of people are going to be sort of freaked out by this, whether you're a retail investor, whether you're on FinTwit way too much, or whether you're a CIO of a $300 billion sovereign wealth fund. Most people think that geopolitics is something that causes short-term movements in the markets that can be played. And I agree, they can be played, but almost always by fading. Sorry, did I say almost always? I meant to say always. So this chart is the S&P 500. And it shows the zero line is a geopolitical event, a major one. We have a data set of basically around 60 geopolitical events since 1956. And what it shows is not only should you fade a move in the S&P 500, but actually geopolitical events can catalyze a bullish outcome. So really, really scary, really sort of mean geopolitical events that cause a lot of clickbait in the media are actually opportunities to buy. The inflection is actually to the positive, not to the negative. And, this is empirically unassailable, as you can see. I mean, this is just the facts. I've sliced this various ways empirically. I've sliced this various ways quantitatively over my career at BCA Research and Clock Tower, and I can just tell you that it's true, both from a data perspective, but also just from my own experience. Some of the best calls I've had in my career, including some of the conversations we've had on your podcast, have been about this sort of like fading of geopolitical risks.
Right. So this next chart, you can see that it actually shows the kind of the decay of how a geopolitical event affects the markets.
So this is an important diagram, but just to be very clear, the previous chart is actual truth. This is just me sitting in front of a PowerPoint and scribbling 2 lines, So this is me trying to like visualize to my clients really what it is that I do for a living. So the light green line is an objective measure of geopolitical risk. This is what people, talk about. This is what they forward on Twitter. This is what they yell at each other about. This is Hezbollah rockets hitting Israel. This is COVID hospitalizations during the pandemic. This is, tragedy of human deaths in the Russia-Ukraine conflict. As you can see, the objective measure of geopolitical risk can remain quite elevated for quite some time. I mean, COVID is the best example of this, although, somebody might contend it's not geopolitics, but fine, just give it to me for a second. Hospitalizations, surges, waves, right? That lasted into 2021. When did the market bottom? Well, we all know that, March 23rd, 2020.
Right.
And that's because the pandemic itself. So the reason there's a dynamic here is that it's a reflexive relationship between the reality policymakers and the market. And so quite often when there's a geopolitical event, it catalyzes policies that actually are quite bullish. In the case of the pandemic, obviously, the Fed started buying corporate debt. We had extraordinarily fiscal stimulus and so on and so on. The derivative of the objective measure is your risk premium or discount. And you can see that it collapses. And it collapses viciously because the market doesn't care about your feelings. The market doesn't care about morality, normative issues, whether you should wear a mask, The market simply cares about the second derivative of the objective measure. And so that's where that half-life really hits investors in the face, because they don't understand how quickly the market moves on, how quickly it desensitizes to a new level of reality that may include a nuclear power invading its neighbor, that may include us wearing masks to go get a cup of coffee.
Yeah.
The market adjusts to that very quickly. And the moment you can see that the objective measure peaks, the market collapses, or rather that risk premium or discount dissipates.
Right.
And I think, now, listen, in our industry, we have many euphemisms for this, like buy when there's blood in the streets. It's not like I'm telling you anything that the old hands didn't know.
Right.
The problem is that it's easy for you to sit, smoke a pipe, have a little bit of a port, and say, oh, you know, the time to buy is when the blood is in the streets. The problem is that when there is actual blood in the streets, 99% of investors, again, from retail to CIOs of multi-billion-dollar funds, they don't have the temerity, to put it lightly, to actually execute on that.
I 100% agree. Okay, so let's go through this next chart, which is the framework for Ukraine was a great example for this.
Yes, a wonderful example. So Vladimir Putin invades Ukraine, and it does really three things. One, I would say that very quickly in the war, while many people were hysterical about the actual decision to invade Ukraine, and then extrapolating linearly from that to like invasion of Poland, nuclear war. I mean, like, serious people with serious degrees and serious positions in government were discussing tactical nuclear warfare.
Right.
The reality was that very quickly in the war, we realized Russia didn't know how to fight a war. I mean, that was a reality. That 40-kilometer convoy outside of Kiev was not a sign of power. Very quickly, we realized that 40-kilometer convoy of military vehicles was there because it was a traffic jam. It was a poorly executed logistical nightmare where the Ukrainian units would just pop off and just kill people on that. I mean, it became a highway of hell. So that was the first thing. We realized there were material constraints that prevented Russia from actually doing much. The second thing we realized is that Western policymakers adjusted to the war. Just as we were talking about, COVID, where they started buying bonds, corporate bonds, and obviously fiscal spending. In Ukraine's case, what they did is they implemented this embargo, which I called a PR effort. The oil embargo on Russia was really just a PR effort, but with CPI hitting double digits in 2022, it was very clear to everyone that there would be no serious, meaningful embargo on Russian oil. And you can see that here. You can see that seaborne crude shipments by destination have remained the same in terms of the level. It's just a composition change. So the Europeans basically said, we're not going to buy Russian oil. We're going to buy Saudi. But then Indians said, okay, cool, we got it. We'll buy Russian, not Saudi. This was clear as they were writing this embargo. You didn't need evidence to see what was going to happen, in particular because nobody at any time discussed secondary sanctions. Secondary sanctions were very important. Meaning that
if you were got caught as India, buying Russian oil, you were in trouble.
Yeah, so an Indian company would be, taken to court, would be forced by the U.S. Treasury not to use the dollar. And by the way, this has been implemented before. So in 2011, this is how Barack Obama got Iran to negotiate the nuclear deal, because they did use secondary sanctions. So the U.S. had a very recent history of successfully using those. And not at a single moment was that discussed at all. They just said, no, we're not going to do that. In other words, it was all just PR. And so as you can see, when you put all that together, policymaker reaction function, material constraint reality, which is an important part of my framework, you get to a point where all of the risk premium that had accumulated, particularly in commodity markets, by May of 2022, the Russians invade Ukraine in February, March, April, great two commodity price months. By May, it was clear that everything should collapse. And by June, it really did. And so the big call of 2022, when you look at the macro universe of various calls you could have made in 2022, it wasn't to go long commodities. It was to short, to fade the geopolitical risk premium.
Right. And I remember you coming on our show, and I remember you saying short oil. And I was like, oh man, you know, gutsy call. It feels so scary. And often the scariest trades are the ones that are right. So let's go to the next slide here. You'll see that actually it collapsed.
Yes. Now, to be clear though, and this chart is important, there is something else here. We can talk about geopolitics willy-nilly, but my argument is not just to trade geopolitics and to always fade geopolitical events in isolation. What you need is the market fundamentals, the macro.
Right.
And so the important anchor in 2022 was what? Well, first of all, the United States of America had 2 consecutive quarters of negative GDP growth in 2022. We don't call it a recession. I don't know why. I guess unemployment didn't go up. Fine, whatever. But there was that. Second, China. And you can see here, Chinese non-oil imports absolutely tank right there in 2022. Right as oil prices goes up, China is basically shooting itself in the kneecap because it is tightening the screws on zero COVID. If you remember, that was the big debate in 2022. They had overstayed their welcome in the sort of club of countries that were very, very concerned about COVID. And so Chinese economy falls through the floor. US is effectively, on some ways, in a kind of a recession, and oil prices are going up. So at this point, you better hope there's tactical nuclear warfare if you're long oil, because you're betting against 2 largest economies on the planet that are going down. And so everybody under the sun, especially, in sort of the social media, retail investors, but I'll tell you, CIOs of major institutional investors as well are focusing on this headline risk, which is in the newspapers, of war. Meanwhile, the macro fundamentals are going against you. And this is just the most beautiful setup for, moving against that headline risk.
Right. So,
and as you can see, that whole space under that chart is unjustified geopolitical risk premium.
So let's go 2 slides forward, Daniel, and I'm going to go to the crux of kind of, I think, what Marko believes. He says, geopolitics and politics creates the macro context, the paradigm that creates the conditions for growth and inflation. In our view, nothing else, or at least nothing that is even remotely predictable, matters. 2 charts, 1 more chart there, Daniel. All right. Tell us about this and kind of bring it back to the kind of the macro big picture, which I think is what you're saying in terms of, yes, it matters in terms of talking about the headlines, but these bigger picture issues are actually what drives it.
Yeah. So in a way, I'm arguing for macro mattering more than geopolitics if you're a trader. If you are thinking about a cyclical time horizon, like 6 to 12 months, what you need to focus on: recession risk, the ISM and the PMI prints. What are copper and oil prices telling you? What is the stock market? What are the signals? What kind of a macro environment you are? But that very macro environment is itself a product of where geopolitics and politics actually matter, which is the longer term. And so it's kind of like a snake eating itself. And so these 2 charts are a good example of where I do think politics and geopolitics matter, and where most investors really don't focus, which is the longer term. So I've been arguing since 2019, really in some ways since 2014 and 15, that we live in a world where politics is going to move away from laissez-faire capitalism. Like I was blue in the face saying this in 2014, 15, 16. Now in 2024, it's like, yeah, duh. Where have you been? Which is cool. Like whatever, it's in my book. Like I'm the guy, the Buenos Aires consensus. The thesis being that we've moved away from the Washington consensus. We're in a different.
Why don't you explain to people when you say Buenos Aires consensus and the Washington consensus, what you mean by that?
Yeah, so Washington consensus is the world we've lived in for the last 40 years. It's the world of deregulation, of privatization, of free trade, of counter-cyclical fiscal policy, and of orthodox monetary policy. It's the stuff that came in the 80s as a result of the suboptimal policies in the 70s. To deal with high inflation of the 70s, what happened? Voters elected the Ronald Reagans, the Margaret Thatchers, the implementation of laissez-faire capitalism. The government pulled away from the market and from the economy and deregulated and privatized much of the economy.
Okay.
And that led to disinflation.
Right.
That led to the 40 years of disinflationary, what we call great moderation. Why is it called the Washington Consensus? Why do we just call it that? Well, it's basically a bunch of best practices that emerged in the early 80s that were then packaged by the IMF and the World Bank and exported to the rest of the world. So if you wanted like an IMF aid package, if you wanted to join the European Union, for example, you had to abide by these best practices. They were called that.
Okay.
So my argument since 2019, so before the pandemic, was like, hey, this is over, and this is over because of income inequality. And this is over because after 2008, we really tripled down on these policies. So we tripled down on policies from the 80s to solve the great financial crisis. Now, why is that a problem? The problem is that the 1980s, we needed supply side solutions because in 1970s, we had too much demand, not enough supply, thus inflation.
Okay.
After 2008, we didn't need supply side solutions. We needed demand side. We needed fiscal stimulus. I mean, this is Richard Koo, the prominent economist who argues we had a balance sheet recession. Private sector was deleveraging. Public sector should have leveraged. But, just like lemmings, our policymakers tripled down on the Washington Consensus. And they said, no, we're not going to actually fiscal stimulate. We're going to do the opposite. We're going to try to cut the budget deficit in the face of private sector deleveraging. Kind of what the Chinese policymakers are doing right now, making this mistake, right? They're trying to
think that they would have learned, but anyways, that's in a story for later.
Yeah. So what happened was the voter was basically hit by two whammies. One was private sector deleveraging, real estate crisis, too much private sector debt. And on the other hand, you had a bunch of lemming policymakers tripling down on supply side reforms that had worked in the 80s, but it was a different macro context. Okay. And so the median voter moved against those orthodox policies that worked in the 80s. And now we got what I call the Buenos Aires Consensus. Why did I pick Buenos Aires? Because I guess I was being mean to Argentina unfairly, because we'll talk about that a little bit later. But, it's like, okay, well, we're asymptotically approaching Argentina. I was trying to kind of, I'm on the sell side. You got to do a little clickbait. So the term was supposed to wake up investors hey, we're not in Kansas anymore. Right. We're not in a laissez-faire world. We're in a different world. So what these two charts show, the chart on the left is sort of why this is happening. I show that the US is by far the most extreme in terms of inequality. And so when the pandemic hit, I told my clients with a extremely high level of conviction, don't worry about this recession. It's what do you mean? This is the Black Plague. This is the Great Depression. We're all going to die. I'm sitting, I had CIOs telling me, Marko, I'm literally in my bathroom doing this on YouTube. We're Zooming from my home. I've got 4 kids in the back. I haven't shaved in 6 weeks. You're telling me to just take my mother to a pawn shop and buy risk? Are you insane? And my argument was yes, because the fiscal response in 2020 is going to be gargantuan compared to 2008 because politics has shifted. Right. Politics has decided that we're going to have a high nominal GDP growth environment. And all your PhDs in economics and all your MBAs have basically made you incapable of making that crucial investment call. This is about politics. This has nothing to do with math. Math is not real. Math is not objective. Math is subservient to politics. And that's exactly what happened. You can see on the right-hand side, the difference in two political regimes. Washington Consensus regime gave us this very tepid recovery after 2008. You can see how personal consumption expenditure in 12 years was $600 billion. So beneath the trend line of pre-2008. And you can see what happens after the pandemic. Thanks to the political context we're in, we get $1 trillion worth of personal consumption expenditure in durable goods in 12 months. And that's because, we hose down American households with just cash.
Okay, let's go to the next chart here where you kind of put together the difference between people using this geopolitical framework for tactical versus strategic asset allocation. Why don't you explain to us what you're showing with this ship?
by the way, just for your listeners to know, I mean, you picked these slides out of my own research, so I really appreciate this. This actually took effort, and this is why I love coming on your show.
I was like, oh, look at this. He's worked hard on his boat and his ship, and there's an anchor, and I'm like, okay, this is actually, makes a lot of sense.
Gotta go in. Yeah, first of all, shout out to Kira and the entire layout and design team at BCA Research, because they entertain my insane ideas. And so in this particular case, I wanted a boat. This is your portfolio. So the boat is your portfolio. And then what I'm arguing on the left-hand side, tactical asset allocation, that's trading. That's cyclical moves. That's like 3 month to 12 month, 0 to 3 month. That's short term. What I'm arguing here is geopolitics are just wisps of the wind. There should not unanchor your portfolio. Your anchor is market fundamentals. It's macro. It's Kevin having a technical trader on his show. That's what matters in the short term. Technicals, macro. What is the growth outlook? Like, that's your anchor. Forget about geopolitics. Fade it. On the other hand, for strategic asset allocation, which is sort of your long-term view, especially if you're an allocator and you're managing hundreds of billions of dollars, you have to think about allocation over a long period of time. Many try to anchor it to 10. I think that's a little bit unfeasible. In my experience, 3 to 5 years should be your horizon, but fine, that's a methodological point. On that side, who wins, who loses is anchored by geopolitics and politics, and that's your anchor. So this is, by the way, for those of you who are listening to this and saying like, okay, I buy that, let's move on, next slide. I just want to pause here for a second. Nobody does this except very, very few, very sophisticated long-term institutional investors. And the reason they don't do this is because this diagram is very controversial. Why? Because if you're a CIO managing hundreds of billions of dollars, presumably you have an MBA or a PhD in economics, or you're seeped in macroeconomics. And so when somebody like me comes to your office, you want to say, hey man, I got the strategic asset allocation. That's in my wheelhouse. I don't need your advice on that. I don't need this political mumbo jumbo. Tell me about Israel Hamas. And my argument is like, no, I'm not going to tell you about Israel Hamas. I'm actually going to poke holes in your strategic asset allocation that a bunch of PhDs in economics have done for you. How? How did they do it for you? What do they know about politics and geopolitics and where the world is going? Long-term investing, long-term growth and inflation expectations are purely a product of politics and geopolitics. There's a few other things like technological change, but who can predict that reasonably well? So my argument is very controversial because I'm basically saying our industry, our entire financial industry is kind of unprepared to do this correctly. I think we need to focus on politics and geopolitics in the long term. And in the short term, yes, that's where you need to be a macroeconomist or a macro investor or a technical trader. That's where you can fade the politics and geopolitics. And most places in the world do it the opposite way. They say, I got this in the long term. You come here and tell me about Israel Hamas.
Right. All right, so let's go through some of these long-term charts. Well, the next one here is the unipolarity leads to globalization. What are you showing here, and kind of walk us through the long-term picture?
Yeah, so this is a great chart from a academic piece of research that one of analysts at BCA Research found, Jesse Curry, just a shout out. We've got at BCA, we've got some incredible young talent that just basically sits in the office until like midnight, pouring through academic research. And then that's the product. This is the chart. And by the way, the reason they sit until 10 p.m. in the office is because in Montreal, as you know, for 5 months of the year, you can't leave the office.
Well, the other thing is in Montreal, the fun doesn't start till midnight anyways.
Number one. And number two, you're snowed in for like 5 months of the year. So Jesse pulled this chart, I remember in 2014 or 15, and gave it to me, I think 14. And he was like, hey, look at this. And basically what it shows is it creates a proxy for trade globalization. And then it shows that the delta of this line is on an upswing where there's a very clear unipolar global environment. In other words, globalization is increasing, trade globalization, trade is like ever increasing when there's someone in charge. And so I've been showing this chart since 2014. Kevin, this is a 10-year chart. And my argument was right there, you didn't yet see this volatility. My argument was very simple in 2014. Like, look, I don't think the world is really run by America anymore. And there was some contention at the time about that because a lot of people confuse power with being able to run the entire planet. Is the US the most powerful country in the world? Absolutely. Like, absolutely, unassailably so. Like, you can't, but they don't have what political scientists call preponderance of power, like preponderance. Think about the difference between 1992 Dream Team, preponderance of power.
Okay.
And today's Dream Team that almost lost to Serbia last night.
Is this basketball you're talking?
This is basketball.
Listen, I'm a true Canadian. You got to talk hockey for me to really understand that.
Yeah. Okay. Well, hockey was always kind of a bipolar or multipolar environment, so it's difficult to say, But
okay,
this chart basically shows you that once you exit that unipolar world, globalization suffers. And what's interesting about that is it doesn't necessarily suffer because two countries hate each other. Just to be clear about that. So it's not like a Cold War environment. What it shows is that once there's nobody in charge, even allies actually start to raise tariffs on one another, to compete for markets, to carve up the world in spheres of influence. So it's not just the Soviet Union versus US dynamic, which obviously kept globalization from spreading to, half of the planet. It's also that 1870 to 1914 environment where it becomes tricky. It kind of moves sideways. And so that's where we are right now. I mean, we're not going to have the 1990s, early 2000s type of globalization.
Right.
I think this is not really used to anyone anymore. But at the same time, it doesn't mean it's going to collapse. It's not going to collapse. We're still going to have trade. It's just that it's going to be less efficient. And you can see that in the way we're, for example, redoing supply chains out of China. We're doing it in a very inefficient way. There's still going to be trade. China's going to be involved in that trade, but everything is just going to be less efficient than in the 90s and the 2000s.
Right. Okay. Let's go to the next chart here. Globalization keeps a lid on real income growth. What is the relationship there?
So this is just same part of the story as the last one. 1980s begin. In 1980s, we had really two things happen at the same time. I'm not sure how interrelated they were, but on one end, you have Ronald Reagan, Margaret Thatcher, creating those best practices that became the Washington Consensus. One of the best practices, by the way, that was very important was union busting. I mean, Margaret Thatcher famously, like literally, one of her first things she did was she raised the wages of the police so that they could go and fight in hand-to-hand combat with coal miners. Like, true story. Now, one of the reasons that this was possible is because in the 1980s, what helped those supply-side reformers was the fact that we did expand global capitalism to the half of the population that lived behind various iron curtains, behind various socialist and communist regimes. And that basically suppressed real income for a lot of developed market workers. And so that's what this shows. This shows you income group percentile. On the bottom is global. You can see that the rise of emerging markets, so the first 40% on the x-axis experiences income growth. That's your emerging markets. That's people who live behind various iron curtains, entering global capitalism, benefiting from that because factories move to where they live.
Right.
So that's that low global income. Then you can see on the far right, that's your managerial class. That's people running the multinational corporations. That's the top sort of 10% sees income growth. And then you have that middle ground. And those are your blue collar workers in the developed markets who don't experience real income growth for a very long time. Again, this is really not a new argument. It's just very neatly visualized.
And this is part of the problem. You're talking about this rise in inequality. Because in essence, we rose up the people behind the curtain or be in China or wherever, but yet the middle America or middle developed world actually suffered.
Yes, except different countries dealt with this differently. So in Canada and Western Europe, there was redistribution, and not because somebody said, whoa, we just moved a factory to Mexico, let's redistribute, but because they have a higher level of social welfare state and spending.
Okay.
And so there were social shock absorbers in Western Europe and Canada. They're just there, like college, university. My kids are all Canadian citizens. Let me tell you, unless they get into Princeton, they're going to a Canadian school because it's cheap and it's free. I mean, you know, like if my kid comes to me and says they got into Brown, I'll be like, great. You know, I don't care. I'm not spending $60K for fake Ivy, you know, like you're going to UBC or McGill. If you're smart, if you're not, you know, Saskatchewan is out there. God bless you. So the point I'm making here is that this is an important chart because, yes, this happened across the developed world, but it hit most viciously in those countries that most enthusiastically adopted the Washington Consensus, the most laissez-faire, because there were least social shock absorbers. And that's, you know, that's why Brexit happened in the UK. That's why the United States of America elected a TV game show host for president. You know, these outcomes didn't really happen. I mean, people talk about populism rising in Europe, in Canada. You know, like, is it though? Like, you know, not really. Like, the next prime minister,
not to the same extent.
Yeah, the next prime minister of Canada is most likely going to be libertarian-leaning Pierre. But the truth is, he's not going to dismantle any part of the social welfare state in Canada. Similarly, in Europe, every populist that comes to power, like Giorgia Meloni in Italy, becomes basically part of the establishment very quickly.
All right.
Whereas the two most radical outcomes happen actually in the countries that were most enthusiastically on the laissez-faire trade. And I think that was an interesting outcome of the pandemic. You saw the US and the UK really stimulated the most because they had the least automatic social stabilizers.
Got it. All right, let's go to the next chart here. It says quantitatively, the world looks more bipolar. Explain that.
Yes, but the next chart. Yeah, so basically, this is one of the ways to measure global power. Yeah. I don't think it's great. This is, you know, it is what it is. But when you actually look at where the world is, it's not as bipolar as people think. So the previous chart shows China, US are basically the most powerful countries in the world. There's Europe kind of behind and so on. But this is an important point. It's starting conditions. So if you go to the next slide, when you think about the starting conditions of the Cold War, right after World War II, US and Russia, Soviet Union, were far more powerful than US and China are today in relative terms. And so why do I show this? It's important because, you know, those analysts and strategists and investors who believe we're in a bipolar world, they're missing that in the 1940s and 50s, when the world became bipolar, Japan had 2 nuclear bombs dropped on it. There were tens of millions of starving refugees in Western European cities that today look like spaceships, like Frankfurt, Berlin. Berlin was destroyed. Paris. So Europe had like Walking Dead like situation. Japan had 2 nuclear bombs on it. India was a colony of a tired, defeated country. You know, like the only 2 games in town were Soviet Union and the United States. So of course the world got locked into a bipolar system. We're not in that system today anymore, and countries are figuring that out. So if you're investing in emerging markets as an idea, the reason this matters, the fact that we're not in a bipolar world, that China and the US are just not powerful enough to force countries to choose one or the other camp. What you need to do as an investor is you need to pick those countries that realize that it's a multipolar world and that they're geopolitically promiscuous. So that's an important point. Like figuring out what kind of world we live in. Is it bipolar? Is it multipolar? Is it unipolar? It's a critical part of your long-term investment, you know, thesis. And multipolarity means that emerging markets that play both sides against one another are great. Like Indonesia is very good at this. Vietnam is very good at this. I would argue India has been very good at it, although it has to improve its relationship with China to really succeed going forward. And then Latin America has been very good at this as well. Countries.
Right, so let's go to the next chart here, because I think this will bring into your argument. Your argument is that we aren't actually in a bipolar world, although it might look like we are. The reality is much more multipolar, and this affects your, strategic allocation in terms of how you invest.
Yes, for sure. So a bipolar world would be almost no globalization, two camps, two sort of separate camps, deglobalized, de-risked camps. And then everybody would make a choice. I'm with China or I'm with the US. As you can see, this chart basically shows on the x-axis kind of degrees of anarchy in the world. And so on the far left, no anarchy. That's a unipolar world. One country decides, there's rules. You have to abide with them, or that country shoots tomahawks at you. The middle world is like less anarchy, but still some conflict, two camps, and then full anarchy, like no one's in charge, is on the far right. And what's ironic is there's a non-linear relationship between these three worlds when it comes to what kind of economic integration we have. So that's the y-axis.
Right. So let's go to the next. So let's go to the next chart, because I think it shows this.
Yeah, right. So this is so what I'm getting at here is that I'm trying to build a strategic asset allocation model. And so you have inflation on the left, global growth on the bottom. And it basically shows you that a unipolar world has the least inflation because everything is efficient. There is pure globalization. A Chinese company can build a factory in Vietnam, send the goods to America. American investors can finance that. Everything's just seamless. And then a bipolar world would have the most inflation because you would have two different camps. This is the 1970s. This is the 60s. In a way, this is a world of like no global capitalism. A multipolar world is somewhere in between. And so, yes, I'm in the inflationistic camp for the next 5 years. I don't think long-term inflation expectations can remain anchored at 2.5%, but don't put me in the same camp as sort of the gold bugs that are, telling you it's the 1970s all over again. It's not. It's complicated. It's the 1870s to 1914. We're in that world.
Got it. Okay, let's go to the next chart here. You said populists have a proven track record of delivering nominal GDP growth.
Again, a very important point. If the U.S. remains the most affected by the shift from Washington consensus to the Buenos Aires consensus, you should expect nominal GDP growth environment to persevere. So over the next 4 years, you've got Kamala Harris versus Donald Trump. Everyone wants to talk to me about polling. They want to talk to me about who's going to win. And I'm like, why do you care? You can care as a human being, but I'm not. I don't. Wait, that sounded weird. I don't look at outcomes from a human perspective. I look at them from a market perspective. And the only true adherent to the Washington consensus, she got like 20 delegates in the Republican primary. Her name is Nikki Haley. She's the one that would have been a different political outcome. She wanted austerity. She wanted rationalization of the American budget deficits. Kamala Harris, Donald Trump, their administrations would effectively do the same thing in terms of continue to target high nominal GDP growth. And this chart simply shows you that if you put a bunch of populists together into an Excel spreadsheet, they always deliver successfully over the first 2 years of their term. Just to be clear, they deliver high nominal GDP growth over the first 2 years of their term. So my team, we put together a big N data set and we prove this. Do you really need to do an Excel spreadsheet? Work on this? It's obvious. Somebody who gets elected or wins power through a coup on a populist platform will always deliver high nominal GDP growth environment in the first 2 years of their rule. After that, it all goes kind of sideways, obviously.
Okay, you know what? We'll take a break from the charts because I got so many and your decks are so awesome. Why don't you kind of put together what this views, like how you condense this into your current strategic allocation? And I believe it's going to be growth is going to surprise to the upside. Inflation is going to surprise to the upside. Be careful what you invest in. But why don't you put that in your own words?
Okay, so everyone listening to this podcast, I would guess that a lot of people lean towards a very short time horizon. I'm just going to guess that.
No, I think that there's a variety of different ones. And I think that also, we can talk about the short term, but the trouble is everyone's always talking about the short term. And so I'm not excited about having you tell me what's going to happen a month from now, because the reality is that's going to be over, and it's not going to really be, it's like a trading call. I'm more interested in kind of your strategic call, the things that you're really kind of stressing and that you believe strongly about.
Well, that's great because it's diametrically opposed to the short-term call. And this is okay. I just want to like kind of preempt it. It's all right if your tactical and strategic calls are different. The tactical cyclical call is based on the recession. Over the next 3 months, I can see commodities going down. I can see dollar going up. I can see US outperforming the rest of the world. Fine. Boom.
Okay.
The reality is that in the long term, if we remain in a nominal GDP growth environment, the US is effectively the most veering away from Washington consensus towards the Buenos Aires consensus. It is quite unreasonable to expect the US to continue to outperform at the pace that it has performed over the last 16 years. We're at the top of a 16-year bull market in US assets. Anyone who travels between US and the rest of the world can definitely feel this. And I think that the underlying reason for this is that populist turn in American macro policy. They've abandoned their very own laissez-faire macroeconomic setting that they basically imposed on the rest of the world, which is kind of ironic. At the same time, we have these extraordinarily high capex requirements that are imposed on us by geopolitics. So we are trying to de-risk from China. And by we, I mean the entire West. We're trying to solve climate change. And by we, I mean the entire West. These are very, very high capex intensive decisions, paradigms, if you will. When you put that together, it's pretty clear to me with a high conviction view that we're in a high capex context. So that means commodities and capex goods like industrials and materials. And that over the next 5 years, we will be in a high nominal GDP growth environment where you should expect any rally in bonds to dissipate very quickly, even one prompted by a recession. So if we do get a recession in the next 6 to 8 months, which I think probability is very high, commodities will come down, bonds will rally, the yields will come down, but those will be opportunities for you to basically move the other way. Expect it to be a very short and non-permanent rally in bonds and collapse in commodities. Over the longer term, the next 5 years, I think the rest of the world will outperform the US. I think the dollar will enter a bear market, the commodities will rally, and I think bonds will also have a very choppy trading. There'll be a tradable instrument. You'll be able to make money by going long bonds on a trading kind of a perspective, but not the kind of a long-term, buy and hold that worked from 2008 to 2020 really well, to 2017 really well.
Right. Now, Marko, one of the things I share a lot of those views, and one of the ideas that when I talk about the shift in politics in terms of the public's willing to spend, and the fact that Nikki Haley was just nowhere to be found, and that we have this kind of change in attitude in terms of deficits. People say, well, you know what? That's actually a short run affair that was brought on by COVID, and it's going to go back to where we were before. How do you push back to that belief or worry that we're going to go back to trying to balance budgets?
No, I don't think it was brought by COVID. I think that's a great question, by the way, Kevin. This is extremely important question. You cannot explain why the US spent 5-6x more than almost any other country other than the UK on COVID, through COVID. You can't point and say, well, Americans were really afraid of COVID. We know empirically that the US was not. US did not impose any of the kind of limits that Australia did, or New Zealand, or many countries in Europe, or even some Canadian provinces. So when you look at America's macroeconomic behavior in 2020, I don't think it is correlated with the pandemic. It is, again, it's correlated with the austerity fetish that had run its course in the previous decade. In a post-GFC environment, politicians became obsessed with austerity. There were no social welfare stabilizers in the US, automatic ones, and so life was miserable. This is why we called it the jobless recovery. This is the secular stagnation. And so political pendulum swing had massively shifted. And when the pandemic happened, it was a catalyst for basically policymakers saying, okay, let's address the pent-up frustration of the median voter. The median voter who in 2016, again, elected a TV game show host as the president of this country. And Trump himself, I mean, you can think of him as God's retribution against austerity, like a mean reversion fairy. Now, this is an important point, because if a recession happens again, what will be the outcome? Now, many are probably telling you, Kevin, that policymakers have learned their lesson, that inflation is now the biggest risk, and therefore they cannot possibly make another mistake with stimulus, which, by the way, this is an important point, because you and I will be massively wrong. Commodities will be in a bear market. Bonds will be in a bull market if politics shifts back towards austerity.
Correct.
And I think there is some truth in this, okay? There is some truth that it's highly unlikely that we see the kind of gargantuan fiscal outlays again in 2025 because we have a shallow recession. However, I do think that monetary policy will be very traditional. And what policymakers are missing is that $3 to $5 trillion stimulus, well, depending how you calculate it, that was given to the American private sector in 2020, 21, 22, it still lives on household balance sheets, on corporate balance sheets. It's captive in house prices. It's captured. That's like the fat where the American households store this stimulus. Yeah. It's stored in the fat of home prices. So, for example, Americans have seen $15 trillion rise in home prices in 4 years. So what happens when they cut rates, which they will be the unleashing of this populism stored in that fat when people start using HELOCs like the Canadians do. Yeah. American use of home equity lines of credit has been very, very, reverse mortgages has been very low. I think once they drop interest rates, this $15 trillion will seep into the system again. So you don't need another fiscal outlay. We had so much after the pandemic. It's still there. And so policymakers will inevitably make what people call the Burns mistake. All Burns did, poor guy, he just cut rates in the middle of the 70s because there was a recession. What was he supposed to do? Well, apparently he was supposed to not cut rates in that recession.
That's a great point. I've never thought about it that way. Yeah, no, you're absolutely correct.
Sure. Look, I don't have a high conviction view on that because I hate when people like shake their fist at the Fed. Like, who cares? The point is, we're not there. Nobody is campaigning right now on pain. Nobody's campaigning on just vicious, like, hey, you know what? If you vote for me, it's going to suck. Now, listen, a bunch of your viewers, listen, I'm going to just preempt your question because I know it's coming. A bunch of your viewers are going to say, like, but Marko, when does that ever happen? It happens. It happens after periods of suboptimal macroeconomic policies. People do vote for pain. Like Margaret Thatcher wasn't walking around saying like things are going to be great. No, she was saying like elect me and my party, and we're going to tighten the belts. We're going to go back to the roots of what capitalism is, and we're going to go after the unions. I mean, it was clear she was girding the country for a confrontation. Similarly, and this is why I said earlier in the podcast, I was unfair to Argentina. Why? Because I named this whole shift Buenos Aires Consensus. But the truth is, Buenos Aires is the first country that had a revolt against this consensus that I named after it. So you have Milei campaigning with a chainsaw in Argentina, and the chainsaw is supposed to be, I'm going to cut the government.
Right.
Thousands of people will lose their jobs because of me. I will bring a recession. Right. And people did vote for him.
Right.
And he has implemented reforms. So I do think over the next 5 years, we will have the Burns mistake. We'll go back into the high nominal GDP growth environment, which means inflation will outperform. And it won't be great. Well, there'll be ways to make money, obviously, but I think for the median voter, it won't be great. And then I think by 2028, 2030, everyone who comes on your show and says this is over, they'll be right. The political pendulum will shift. And I'm pretty sure the next US election, the next Canadian prime minister, the next, German chancellor also coming next year, they'll have to make this pivot back towards something looking like the Washington Consensus.
Got it.
That will be painful in the short term, but probably the smart thing in the long term.
Okay. That's terrific. That's a lot of great stuff on a long-term view. I'm going to ask you one short-term thing. You sent out an email to your clients, and actually I saw you tweet about it when there was a Trump announced something. Here it is. Here it is. President Biden has announced his withdrawal from the president race. There's no doubt that that'll dominate, but really what's more important is Trump. And he argued that the two most important things that Trump had said was large factories are being built across the border in Mexico. They're being built in China. We don't mind that happening, but those plants are going to be built in the United States. by our people to man those plants. That's what Trump said. And that's pretty clear. I kind of get that, what you're arguing. But the second thing I thought was interesting, and I need a little help with because I'm not as up to speed on this, is you talked about the tensions with Iran. And Trump had said the following: Iran was broke. Iran had no money. Iran was going to make a deal with us. And then we had that horrible, horrible result that we'll never let happen again. Explain to people why you think this is a big deal and what it means.
Well, I think it's a big deal because it reinforces something that I've argued about Trump. We have 4 years of empirical evidence of his foreign policy. We have 4 years. It's okay in 2016 to say Trump might lead us to World War III. That's a fair statement. Fair statement. You have no idea. He's a real estate developer and a TV star. Like, come on. Who knows? But after 4 years of empirical evidence, where he doesn't start a new war or deepen an ongoing war, first time since Jimmy Carter, and where he does negotiate like 4 meaningful trade agreements, as opposed to Biden, who didn't negotiate a single one, you actually have enough empirical track records to say, wait, hold a second. Maybe I'm reading too much New York Times when it comes to what Trump's foreign and trade policy will be. And what he said at his convention speech, which nobody listens to the whole thing, people pay me.
Pretty long, Marko.
I know. Well, I'm paid to do this, so I have to. Feel sorry for me, But I listened to the whole thing, and on top of that, he's actually been using these. Like the convention speech is just really his bit. He's like a stand-up comedian. This is his bit. He's doing this. He goes from one campaign rally to another. He does his bit. So he's been saying this for 6 months on both sides. He's basically saying, look, I am who I was in those 4 years. I want to negotiate with anybody. With anybody. And so anybody who says like Trump is anti-China, Trump is anti-Iran is missing the point. He is truly nihilist. And he is arguing that he was close to getting Iran to sign on to a deal that would have basically refreshed the Obama nuclear deal that, of course, Trump in his campaign speeches, he blasts that deal. He's very negative towards it, which is politics. He's, I think, unfairly, negative towards the Obama deal. But he himself wants to basically get another deal with Iran that he will then present as a better deal. And I thought that was very interesting because during his term, he did employ some people in his administration who were hawks, particularly on Iran, like John Bolton, and then also hawks on China, like Peter Navarro. And I think that that's also interesting because it tells us that those people are there just to scare his opposition. They're like totems. They're tools. They're like chips in a poker game. Like, you go to China and Peter Navarro's at the other end of the table. Like, hey, if you don't deal with me, I'll send this guy at you, And they're like enforcers on a hockey team. To put it into an analogy,
there
right?
We go. I get it now. I didn't understand up till now, but I get it now.
But they're not necessarily going to go on ice, but if they do, so the point is, I think that was really important. Nobody covered in the media at all because it doesn't fit a neat narrative that, Trump is likely to start World War III and deepen trade wars. I actually think it's the exact opposite. I think if he comes to power, you'll have a lot of volatility in the first 6-12 months. He will raise tariffs on China. He'll be super mean. He will launch some rockets into some Iranian troops somewhere. Yes, he will. He'll do all that. But it's all in the interest of finally getting a deal.
Okay. All right. So we're going to end with my question, the triple Bs, which is I want you to see if you could share with us a book, a broadcast, which you can call a TV show, a podcast, anything that you've seen, or a band that you've recently come across. It's got to be new, something you've just recently discovered that you like and you want to share with everyone.
Yeah. So I love listening to podcasts. Obviously, it's tough to listen to new ones because I always spend a lot of time listening to Market Huddle. It's difficult.
Okay.
But Acquired. Have you heard
the podcast? I don't know it. Is it? And it's good. Tell us about it.
So Acquired is a podcast that started off as focused on tech. Two sort of tech experts from Silicon Valley do it. And it's since then migrated to many other sort of industries, and it's basically 3 to 4 hour episodes on a particular company. And I would argue that their 4 hour thesis on LVMH and Hermes are two of the greatest podcast episodes ever put together in history of man.
Wow. Okay.
Yes, even if you don't care about the fashion industry, it is extraordinary. They've done, I think, a two-parter on NVIDIA, which is like 8 hours long. They just released one on Renaissance Capital, which every one of your listeners would want to listen. So the name of the podcast is Acquired, and they're very, very long. But I like that because I have long periods of time when I'm doing something, like you're working out or you're in an airplane. And it's just incredible. I mean, they go in such great detail and they do such incredible research. That's why it takes them months to release a new episode. So if you want long form, well-researched, in-depth podcast that you can zone out to, I find Acquired really good.
That's awesome. Okay, Marko, thank you so much for being on the show. Why don't you tell people where they can find you? And I guess for institutional clients that don't realize that Marko is now at BCA and going and you can buy their product, why don't you tell them where institutions can reach you and then where retail would find more about you as well?
You know, Twitter is a great part to start. If you are a retail investor, you can hit me up there. For anyone interested, you can just reach me at marko@bcaresearch.com. So I'll give you my email address and hit me up there.
All right. So for any institutions or, family offices or anything, make sure you go and check out Marko's work. I'm sure they'd be more than happy to send you some stuff.
K. Just to be clear, it's Marko with a K. Marko.
All right, Marko, thank you so much for being on the show. I always appreciate you being on.
Thank you, Kevin. Always a fun.
All right, Patrick, it's time for Talking Charts.
Let's do it.
What do we got? You're very excited.
No, let's do it.
Chomping at the bit today.
Well, listen, there's lots to talk about. Let's not waste any time getting to what all the good stuff here. So listen, let's just go through what we saw come out over the last 2 weeks that we were watching. And number 3 was jobs numbers, and based on it was a miss. It was a big miss.
It was a miss, but not only was it a miss, Patrick, I think it was the final number that made it kind of market concern that we were going to have a recession.
Yeah, was it the SOM rule that basically?
Yeah, the SOM rule kicked in. A lot of people panicked. It was the. We've kind of been leaking that way, and it was the number that put everyone finally into the recession camp.
Yeah. Number 2 was Mag 7 earnings, and the point we were making is that many of them were likely to come in line or even beat the numbers, but it was about guidance and about the fact that everyone had already high expectations. I mean, it wasn't enough for them to just make their earnings. They had to really kind of impress and even make it look like there was more to come. And most of them disappointed.
Yeah.
And so it
bar
was
to jump over.
It was a very high bar to jump, and we'll talk about those charts and what's going on. And of course, we were watching the FOMC and the Bank of Japan. Clearly, FOMC was important, but it happened to be Bank of Japan that shook the world, right?
Do you think so? Because actually, I actually don't feel that way. I feel like the yen was, yes, at the epicenter of the move, but I don't think it was really the Bank of Japan. Everyone was expecting them to raise rates. So although I agree with you that the yen was a big factor, that obviously the unwinding of the carry trade caused the thing, but really the Bank of Japan did nothing that wasn't expected.
But yet it was, because ultimately it was such a positive trade that was making so much money for so many people for so long. And I think that it changed the thing. It's like that spread is no longer, it's going to narrow. The Fed's going to start cutting and Bank of Japan's going to be raising. And everyone's realizing that that story's played out. And I think that it just became someone yelled fire in the theater, and there was just one exit door, and they trampled each other to get out.
The other thing is, I think that people forget, but the FOMC, when they came out and they guided towards a September cut, which some people thought that there might be a chance that they would do a July cut, but there's no chance of that. Like, that was pipe dream, but they guided towards the September cut. And if we go back and look at the charts of that day, Patrick, we actually had a huge rally. The NASDAQ finished at the high of the day, was up 2-3%. Everyone felt like we were going back to the same sort of bull market and that the correction was finally over. Even Thursday morning, the day of the morning after the FOMC, we got up and it gapped higher again, but then it rolled over. By Thursday afternoon, we were below the point where the FOMC had kind of met and goosed the market.
And
And
the
then by the
jobs.
end of the day was on the lows. And then Friday we had the unemployment number and it was just a huge gap. And then the shit really just hit the fan.
It really hit the fan at that
Yeah.
point. And
But
that's
it was,
exactly.
but the point is that I just wanted to, highlight is that people forget, but the FOMC on that day, it actually felt good. The market was rising and it felt like the market might actually put in a bottom. And yet it was just, it was overshadowed by the FOMC, by the unemployment a couple days later.
All right, so let's talk about the top 3 things to watch in the coming weeks. And so number 3, well, we have the OPEX coming up next week. And the thing is, typically, we have a scenario where OPEX tends to be pinning the markets, which is more often than not, it's a factor. But once you have a market that is already gamma flipped in some degree or another, we're challenging some lower strikes, sometimes the opposite happens and you get heightened volatility in this condition as that gamma kicks in. And so one of the things to watch simply is that will we actually have more volatility next week because of the pending OPEX? Do you have an opinion on that?
Well, I don't really have an opinion, but I just want to explain a little bit of the option jargon that you just cited. And what Patrick's citing is the fact that as the stock market goes higher, generally most clients have sold call options against their portfolio so that the market makers are what's known as long volatility. And when they're long volatility, they end up buying dips, selling rips, and they condense volatility. They in essence dampen volatility with their positions. When you get a move away from those strikes and you move it down to the strikes where the market makers are actually short, meaning that people have bought put protection down 5%. Now all of a sudden we're there. The market makers, to hedge their position, actually have to chase rallies and then they have to sell, declines. And they're making it worse,
exacerbating the volatility.
That's correct.
You know,
that's what Patrick is highlighting is the fact that since we've moved away from the point where we were previously long gamma, or not we, the market makers were long gamma, we've now moved into a part of the market where they're actually short. Yeah. And as those positions unwind, we might get more volatility.
I'm getting our good friend Brent Kachuba at Spot Gamma. Let's get him on the show for a Huddle Plus. And
that sounds great.
Take a deeper dive into it because I think it's really valuable for our listeners to know a little bit more about this. All right, so number 2, inflation numbers coming out. Now, inflation has always been a big factor, but I mean, at this stage, 25 to 50 basis point cut is now baked in. So I don't think the inflation number is going to dynamically change anything.
Really?
But it is an important.
Imagine we got a hot number. I'm not disagreeing that they're
then
still
they
going
go
to
25 instead of 50, right? Like it
no,
might.
they're
might
not doing 50. Like I'm going to push back on that. I think that actually what you're playing for is the next meeting. I think that they're going to cut. Absent an absolutely screaming inflation number, which is not going to happen. But let's just imagine that inflation airs on being a little more or uncomfortably high for the Fed. I think they still cut in September, but then they go and they pause. Because don't forget, they were previously, Patrick, on like 1.25.
Yeah.
Like they weren't on this every single meeting. And like the market ran ahead, and the market was not only was it every single meeting, it was actually 4 cuts over the next 3, meetings. Absolutely. So if we got an inflation number that ended up being hotter, I could see us going to, over the next 4 meetings, 2 cuts instead of 5 or whatever it's got priced in.
So the CME Fed funds futures are actually showing a better odds than not that they go 50 basis points, like 53% versus 46.
Really?
Now, you might not
I'm
put the same weighting, but that's, you could fade it. But I'm just saying let's just call it a 50-50. They're now the market is literally starting to bake into and that was even actually higher during the yen
Oh, 100% it was higher. I think it was
like
almost 100%. I think it
now
was
of 2 cuts.
85 or 90%.
Yeah,
It was
like
because you had Jeremy Siegel getting on TV and
Yeah.
crying that they needed to do an intermediate cut.
yeah. And so you can see here that even for year end, I mean, now the belly of the distribution is like a 46% odds that we're down almost what's it called, 1 full percentage point by year's end in the December meeting.
Yeah.
that
So what's that? How many meetings? I think we have
that's
3 meetings. So,
3 meetings.
yeah.
So they're giving the highest
So
probability 4 cuts
four
in
over
3
the
meetings.
next 3 meetings. Yeah. No, I get it.
Yeah, that's but anyway, the
But my point
here,
is, though, if inflation ends up being hot, Patrick,
then they'll
I-
have to taper that,
yeah,
right?
that's
But
my point.
and
I'm not
that's
saying it's going to be hot. I
Yeah.
don't know what it's going to be. It's kind of random. There's like, on the whole, we are in a disinflationary trend. Just any meeting, like any single meeting, anything can happen. You get some random thing, and all of a sudden, changes the whole narrative.
right. So listen, number 1, is the bull market over? Listen, I'm asking it as a question, but I do have an opinion on this. I feel that the blowing up of the carry trade has a very reasonable probability of being like the watershed moment that shifted the tide. And the way the analogy or the example of what to me this was like is potentially the same as when the Bear Stearns hedge funds started blowing up with subprime in July of 2007. That marked a 10% market correction that happened. Now the market still retested its highs in October, right? It wasn't that it was just all downside from there, but everything changed. It was at that moment, the 2006 into 2007 bull market that ran 20-30% on the upside was over. And it began a big topping formation, and the market upside was very limited from that point on. And while I don't think that this is a straight down move, and I don't think the market has to go crashing lower, but I think that huge 9-month bull run that we had, it's done. And the market's going to be very heavy going into seasonality now is a factor in that. And you just have the Mag 7s rolling over with their huge market cap weighting. I think it's going to be very hard for the market to go and make new highs. And it's going to be a meat grinder here for many months going into the election.
So I agree with that last statement about the meat grinder. I think it's going to frustrate the market's going to frustrate both bulls and bears. And
it always does. If it was easy to short sell, everyone would do it.
Right.
The market is not going to make this easy for the short sellers.
Right. And I happen to agree with you that if the bull market's not over, the even if we go back up to the highs and we push higher by another couple of percent, the I hate to say the easy money, because the easy money was never easy, but the kind of, there's going to be no meaningful move to the upside from here. It's going to be a grind.
Exactly.
And so
I'm
with you there, but I'm going to push back about the reason for it, though, because you're blaming the yen carry trade.
No, I think that becomes the to me, it was one of the things that was a tailwind that now is no longer, the wind in the sails is taken out. It changed the sentiment of the market.
So I don't disagree with you there, but I would argue that it was more the bloom coming off the rose of the AI narrative than it was the yen. And I think the yen,
but the Mag 7s were
just
benefiting from a lot of that yen.
But I
carry.
almost think that the yen going down might have been because the stock market was going down.
Yeah.
Like I'm not as sure as you that the yen went up and then that forced the stock market to go down. I don't buy that. I think it was kind of one and the same. I wrote about these NISA accounts in Japan, which is in essence like their RSPs or their 401ks. And recently they were able to go out and expand the amount of assets they buy. They used to only be able to buy Japanese assets, and the tax was super convoluted and stuff, so they weren't very popular. Well, this year they changed it so that they could go out and buy foreign assets, and they made the tax much simpler. So I do believe that a lot of Japanese retail investors were going out and buying Mag 7, and that buying of Mag 7 actually caused, they had to pay for it in US dollars. So it was causing, they were selling yen to buy
But even
Mag
if they were
7.
just buying S&P, the market cap weighting was pushing
Right.
them into the
Yeah, and
into the mags.
so I do believe that that was the thing. I guess where I'm pushing back a little bit is that the yen carry trade was the cause, and I just think that the reality is that the Mag 7, that pricing just got stupid. Like this AI trade is absolutely ridiculous. We're going to look back and
Yeah.
people are going to be embarrassed about the things they said and the valuation of these things, and the idea that we have these semiconductor stocks that everyone's treating like they're forgetting that semiconductors are cyclical stocks, and they're just putting on these kind of magical, you got to be long AI, so therefore it doesn't matter the pricing. And this is the part that really kind of worried me, Patrick. I saw really smart people on TV, Steve Eisman from The Big Short, and he's talking about the secular bull market in AI, but never once does he talk about the valuations. He's just like, you got to be long. And when you get that sort of mentality where price doesn't matter, you just have to be long. Like
It's
I,
always
I just
dangerous.
think that that's insane.
I
There reaches points. Every trade / investment has a price where you buy it and has a price where you sell it, and nobody even considered there was a price that where you sell it.
it echoes the dot-com bubble in that you can make these kind of undisputed claims like the internet will change the world,
Right.
and it will and in everything will be different because of the internet, but you can't refute that statement. That's true. And yet and Amazon will be the market leader. Well, was it wrong? No, it was absolutely right. Amazon ended up being the retail leader, and it is still one of the largest retailers now in the world. Yet Amazon lost 90% of its value during
Right.
the dot-com bubble. And the thing is that that's again, that to your point, is a valuation thing, which is I'm sure these semiconductors are great. AI is the future. All of these things will happen, and somehow Nvidia will still lose 50% of its value in the next bear decline, and investors are going to get blindsided by it, and that's just the way the cycle always works. It's never different. It always plays out the same way.
Patrick, I got this little thing on my letter where I do like an audio clip, and a couple of weeks ago I highlighted this fellow from Cotu, and that's a big kind of famous investment house that does growth stocks, and
Right.
he was talking about why he was long Nvidia and why it was just like buying Apple in 2014. And he said in 2014, everyone was telling me that Apple couldn't go up and all this stuff. And then he said, I pushed back and I bought that. And I'm just pulling up the chart here. Let me just pull it up, because I remember looking at the price to sales of Apple I'm just using sales because it's easier to kind of understand it.
2014.
Yeah. So if we go back and we look at Apple on let me just pull it up here, weekly 10-year. So 10 years ago, when he was buying Apple at like 2 times sales, right? That was also when Buffett was buying it. Okay, he's buying Apple at 2 times sale and saying that this was a huge contrarian call, just like Nvidia is a huge contrarian call right now. And I'm like, you can't put those two in the same bucket. Today, you're paying 35 times sales for Nvidia, and you're trying to say that
That's
it's
the
just
same
like
thing.
buying Apple at in 2014. It's ridiculous. And going back to Apple, by the way, Buffett bought a ton back then.
He's
What did
selling
he
now.
announce this week?
That he unloaded half.
Yeah. He bought 2.5 times sales, and he's selling 9 times sales.
And we just
The
had
old man still
Jesse.
knows something.
We had Jesse just on for the Huddle Plus, and he was talking about including the huge amount of sales that Jensen is doing at Nvidia. Like this, insiders are profit taking. The only way to keep some of it, like, I mean, you're always going to have a certain multi-billion-dollar net worth because of your equity shares, but the only way you have a better lifestyle is if you turn some of those shares to cash.
Right.
And when there's no better time to monetize some of it at the turn of a cycle. And these guys, if we weren't seeing like that one Goldman trader was talking about that typically the capex cycle in semiconductors and AI stuff is usually 4 to 6 quarters, and here we're in the 5th quarter. Why is it that management is so eager to do insider selling if they believed that there was another 4 quarters of expansion?
Yeah.
They wouldn't be doing insider selling, right? Like,
Well, yeah,
but
it's just the price that you're paying for that is really the issue.
yeah,
Like you could be right on the fundamentals and still be wrong on the fact that the pricing is just so insane. And this is my point, is that people, like serious people, are getting up there and trying to equate buying Nvidia today the same as buying Apple in 2014, and they're just not the same. And the fact that this person was able to do this with a straight face just shows me the kind of bubble that we're in.
yeah.
And this is just I think that it's absolutely insane, Patrick. And then we're going to look back and we're going to be like, what were we thinking? Like, remember the Stock
Yep.
McNeely speech where he gave when he said that it was insane when you were paying 11 times earnings.
Yeah.
And that wasn't on the world's biggest company. And yet here we are, the world's biggest company, 35. No, it wasn't 35, the 11 times earnings. It was 11 times sales.
Absolutely.
And now here we are, the world's biggest company is trading at, 35 times sales, and nobody is stopping to think about the absolute insanity of that. Anyways, I go back to Patrick about this thing about whether it was the yen carry trade, whether I've argued it's the dispersion trade. There was lots of different factors.
Yeah.
Ultimately, I think it was an increased chance of recession. I've always said that that's what's going to cause the next bear market. That's the real problem. It was exacerbated by the yen carry trade, and also the fact that these AI pricing is just absolutely insane.
You're right. All right, let's talk some charts, buddy.
Okay.
So the S&P here obviously has this tumble. Before we even talk S&P, let's just talk about the absolutely insane movement of the Nikkei and the yen. And just like, so here's the US dollar yen, 2,000 pips in less than a month, or just close to a month. And one of the most extraordinary forex moves, considering almost all the other currency pairs continued to be stuck in a meat grinder range for this one pairing to make such an extraordinary move. This is sort of like the equivalent of when George Soros broke the Bank of England, just like a 2,000 pip move in a month like this. This is like some redonkulous money that was that just exchanged hands in this one move. But what was crazy about it was that, okay, we could, I kept razzing you for being early to this trade, but in the end, you were bang on right. But what was crazy was the impact it had on the Nikkei.
And I missed this. And you actually, to be fair, you were highlighting this as an ugly looking chart and saying this could get a lot worse.
25% in
it was the worst. It was the worst one-day crash, Patrick, apart from 1987. It was the second worst one-day crash ever. Like, think about it. The tsunami wasn't
high,
as bad.
12% on
yeah.
It was insane. And but the reason the market's bouncing right now, in my mind, is the Nikkei. What you want to visualize it for our listeners is it's like there's a reflexivity to everything. And the way I like to give an analogy is, imagine someone jumping off a bridge with a bungee cord on or tied to their feet. When you jump from a very high bridge and it's a big bungee cord, this is what happened. It just stretched the bungee cord to its maximum. And then as soon as that reaches that point, the snapback is going to be somewhat proportional to the magnitude of the decline, right? Like there's going to be some sort of thing. And so when a Nikkei can drop from 40,000 down to 30,000, it's going to snap back 5,000 points very easily, just because of the magnitude of the prior decline. There's a proportionality to all of this. And so the Nikkei wasn't going to go and drop another 10,000 points. And so we're getting now the point where the Nikkei is reflexively snapping back. This has caused there to be a kind of a pause in everything. Well, S&P snapback, everything kind of taking a breather from the bloodbath. The bigger puzzle piece to solve here is that does this all go and retest those lows? Like, when you get the snapback, the dead cat bounce kind of thing, is this now going to be a scenario where in months to come, the Nikkei is going to crawl right back for a double bottom retest of the lows? Or is this just going to keep ripping higher? And that was an amazing opportunity to buy in a V-shaped recovery. I don't know if I have too strong of a conviction on the Nikkei specifically. I have a stronger conviction on the S&P, but I think that this is a really interesting thing to watch, because if the Nikkei goes ripping back to 39,000 and everyone's suddenly buying the dip on this thing, which I don't actually think is the greatest probability, but let's just say that happens. I think the whole market is going to take that as a tailwind. And I think Japan's going to continue to watching what happens here on this chart, I think is going to continue to trickle in and influence all the global equity. And what happens here next, I'm very interested. This level right here, 37,000, is the Fibonacci retracement zone of the crash. And so this is now bounced exactly the amount it should have. And so what happens next is the tell. And that's why I think over the next week or two, let's seeing whether this bleeds back to 33,000 on the Nikkei and stuff like that is going to be an important thing to watch. You have an opinion? Nothing.
I do have an opinion. My opinion is that the Nikkei is going to outperform the NASDAQ and outperform the rest of the world going forward. And that this was overdone, and it was kind of technical. And
the stock market there was stupid cheap in the first place, and it got stupid cheaper by with a 25% decline. So
it was crowded. There's no doubt about it. I think that there was a lot of folks that were hiding in it because they viewed it as an extension of the yen carry trade, and that if the yen continues to be 160, they're going to continue to do great because they're stealing growth from the rest of the world. And so now we no longer have that kind of currency abnormality tailwind, and the kind of the economy is going to have to stand on its own at a more reasonable currency level. And I'm still bullish on it. And actually, ironically enough, Patrick, one of the things I'm worried about is that they panic and stop raising rates. And I know that's going to sound insane. And like, why would you be bullish on the stocks if rates are going higher?
Mm-hmm.
I look at this as, if you think about the US, when they first started raising rates, we had a situation where the market got nervous, sold off. But then as the people realized that the rates weren't going to cause a recession, weren't going to cause a real problem, we actually had one of the best bull markets we've had in ages. And I suspect the same will happen here. I don't know about the timing, so I'm not sure even what the Bank of Japan is going to do. But kind of a year or 2 years from now, I suspect that we'll go back to Japan being one of the top performing stock markets, if not the top performing stock market.
I'm not bearish the Nikkei, and nor do I want to be short the Nikkei. Probably your scenario of outperformance is going to be bang on. I actually don't push back on any of that, but I think global equity correlation will matter. And even though the Nikkei may outperform the NASDAQ, I think that if the market has another shellacking, all the markets are going to be red, including the Nikkei.
I don't disagree with you that, but I think that the days of the Nikkei leading on the downside are gone.
Yeah,
like that was it. That was the big pain because of the currency.
I'm with you.
And I think that from here on in, I'd be much more worried about the NASDAQ with its kind of lofty valuations and their problems there than I would be about Japan.
Right. So what I want to talk about briefly before we talk the S&P is the VIX. Okay. So we had the VIX just puke. Like, we have not seen a 60 handle since the COVID crash and the 2008 crash. Like we have not seen, and that was just, and the market was only off 10% off its highs. And we have this kind of VIX puke. And one of the things that, like, for instance, we had this 100+ point S&P rally yesterday. And a lot of people, it shifted sentiment. It's like, oh, I'm missing out. The bottom is in. But, when you're talking about a VIX in the 25 to 30% range. The implied daily range of the S&P is 100 points. Like this isn't a crazy move we saw in the stock market on a relative basis to where implieds were implying. So the point I want to highlight, even though the VIX is coming off because the market's kind of settling in, we're in a situation where the S&P bouncing to 5350 to 5400 was a fib retrace. And I think the real tell happens here, because if this market has a date with 5,000 and or a double bottom retest of 5,100 where it put in its low, it's going to fail right here. It's going to fail right at this level at 5350 to 5400, and we're going to have one of those 200 to 300, 400 point spills to kind of establish a trading low. Whether it happens is something that's not totally certain, but if it's going to fail, it's going to fail here. This is what I'm in my call on this. If the market clears that level, then we probably have a short-term trading low. But the high of the year is in my opinion. I'm making that call. I mean, might be a double top retest. There might be, a prairie dog that for 3 days manages to muster up a previous high just to wipe out some stop losses above a previous high. But the high of the level of the stock market, the high's in. This is my call, and we're not going higher. And that's and I think that any rallies should be shorted. That give you some sort of asymmetry up along the top end, and so that's where I'm going. If I still think though that even if we did spill to 5,000, there's going to be a pre-election rally that could easily see the market trading at levels where we're now or even higher. Like, I think that there's no easy short here. This is all for day traders messing around with, a 1 week swing in the market. If you don't cover quickly, you're going to get squeezed out the other way. It's going to be a big meat grinder in both directions for a little while. Even using that 2007 analogy, while I think July 2007 was the turn point, that's when the Fed started cutting interest rates and Ben Bernanke started easing and doing all that. The bear market didn't start for another 6 months. All right, or 4 months, 5 months later. Just because we have these kind of a turn point doesn't mean that this is all downside from here. And this is, I think, where everyone needs to curb their enthusiasm in terms of how much downside there is on the very short term. I don't think it's going to be easy.
Can you pull back up the VIX?
Yeah.
I think a couple of things that I just want to comment about this. First of all, everyone's surprised about the VIX. Everyone's like, wait, what? One bad employment number. Why did the VIX rally so hard? I felt like Chicken Little about this dispersion trade, Patrick, for the past 6 months, talking about it and writing about it. And everyone thought I was insane. And I really do believe that this dispersion trade was larger than people think. In essence, they are short VIX kind of implicitly from there, depending on how you structure it.
Because you're going index against individual names, right?
Yeah, and as correlation rises, they have to cover by buying VIX. So the first thing is, I'm not actually that surprised about the VIX. And me, I've been long the VIX, and I hate being long the VIX, and I've been kind of calling for this and writing for this VIX spike. It was higher than I would have ever anticipated. But I do want to call out one aspect of this. When you pull up this chart, you're pulling up the cash VIX, and the cash VIX had a settlement in there. And what we had this weird, that I guess it was Monday morning, we had something expiring or some point along there. I'm not sure exactly when it was, but the market makers were scared and they just widened quotes. So one of the things that you need to remember is that in an environment where there's wide quotes, the VIX kind of cash index uses the mid-market. So Dean Kernut from Alpha Exchange, he wrote about this, about how there was some sort of expiry or settlement and everyone just kind of backed off. And so you had some extremely wide quotes at some parts of the curve that caused the VIX to spike to points that weren't really tradable.
Yeah.
And if you look at the VIX future, like if you just take like August future or whatever, it didn't spike anywhere near what that cash index did. So I would put a big, huge like asterisk on this chart and say that that wasn't really the price that it was
Fair enough.
tradable, and it was very fleeting. Now, even a move to 40 or 35 was a big deal, but I think that you just need to remember and keep that into account when you're talking about the cash index. That was not tradable. It did not trade there. It was not as bad as it looks. Yes, it was bad. And yes, it was bad because I think we had a situation where it was made worse by the dispersion folks. And yet we're back, Patrick. I guess I feel like we're going to grind lower on VIX from here. I think we're going back to sub 20.
Well,
I think
sub 20, I could agree with you. Back to 12, I don't think.
No, we're not going back to 12. But
No.
I don't
Teens, high teens, absolutely. It's
Yeah,
plausible.
we're just gonna, like,
That's a very
summer's
normal.
here. We're like, this is still like, that was it. That was a little spike. We had this kind of wake up call on this recession. A bunch of things came together all at once. All of a sudden, everyone had to come to terms with, yes, the recession might be here. The AI is a cyclical stock, and they're way expensive. The yen trade comes all unglued at once. The dispersion trade comes unglued all at once. You had this kind of just confluence of events that caused like a few days. But realistically, one of the things I'm shocked at, Patrick, is how well it's behaved. And the other thing I'll just kind of point out, one thing that it's kind of led me to believe that, it's not going to be as bad as everyone thinks it is. And I find myself much more comfortable, Patrick, because I remember I was the biggest bear out there, and I felt like all alone when I was sitting here trying to be bearish, and everyone's telling me why stuff never goes down, Mag 7 never goes down, yen never goes up, blah 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 blah. And I'm like, no, this can happen. I feel much more comfortable now pushing back against all the newfound bears that are all of a sudden telling me why the world is ending. Look at credit. I am shocked at how well credit's behaving.
Okay, I want to talk about that's actually where we're going next.
Okay, go there, because I am just flabbergasted at how well it's behaved.
So here, by the way, is just the U.S. high yield broad basket, and this is the credit spreads. We went from 3% towards 4%, so, certainly pulling back a little bit, but we did have a spike. But when you put it in the context of the ranges we've been in the last 3 years, we still haven't gotten anywhere near where the levels where we were trading in spreads during the bond bear market. And so, but the question is it a change in trend? Junk bonds were not where the selling was, right? I'm just going to use the J&K, but like we're much closer to the highs than we were to the lows in the last little bit. And certainly high yield is not the stress point. And to me, it's always been a canary in the coal mine, and this canary is live and still
Chirping away.
flapping and chirping away. The signal from these credit markets has not come.
Yes. So one of the things I just want to say about this, I agree completely. And I wrote a piece way back when about this, about how can you tell when a correction is going to be a 10% correction versus something more sinister like a 20% correction. One of the things you can look at is how credit behaves as you go down to those levels. I will just say this, though. I think the market has gone much faster than it's ever been. And all you have to do is just look at this. It came out of the blue, in terms of this correction. It literally seemed like it was over in 3 days, and it came very fast. So although right now credit is extremely well behaved, if all of a sudden we got 3-4 days of a big widening, I would be completely off this. So all I would say is don't like say, oh, the guys at Market Huddle say the credit's well behaved, therefore I don't need to worry about the stock market. Right now, credit is well behaved, so therefore chances are the stock market won't be in a vicious bear market. But be careful, because watch for those things to all of a sudden quickly come out of the blue. I could see a situation where out of the blue, the next actual kind of sell-off starts in credit. And those are the ones you need to be careful of. And that's kind of my point, is this feels like it was a correction made worse by the yen, by the dispersion trade, by lots of different things. So far, the actual economy is pretty decent. as evidenced by the fact that credit spreads haven't widened. And what you should be really watching for is when the credit starts leading us, and those are the declines that are scary.
Okay. I'm with you, and that's the whole point, though, right? Like this is why the meat grinder narrative has a reasonable chance of happening. Anyone who's piling in short, thinking that it's all downside from here, and it's going to be challenging. It's going to be
Not only that,
challenging.
Patrick, you highlighted the fact that VIX is a lot higher, so you're paying more for the options.
Yep.
And rightfully, you also highlighted that the actual moves are much higher on the intraday moves, so you're more likely to have to like get
Mass
stopped out.
confusion.
Yeah.
Mass confusion. No,
Dogs
but
and
like
cats living together.
it's insane.
Mass
man.
hysteria.
Mass hysteria. Let's talk about though the bond moves. Obviously, I was bang right and you were wrong.
No,
And
I disagree. Pull up 2 10s. You were better off in the front end of the curve.
yes, well, actually,
That was
totally.
all
We were
I
going to
was
talk.
arguing. I was
Uh,
all I was saying was that you were much better off at the front end of the curve.
okay,
And
listen.
so
Okay,
if we
you know
are
what? Where I'm going to push back on you is that playing the front end of the curve as a sophisticated trader that has access to the derivatives markets and can, on a relative basis, lever up the 2 years. And okay, you're going to give me
But-
the TUA and shit like this.
Yeah.
But the point I'm making is that for an average investor who's just bond allocating, made a larger percentage return on the long end.
Of course, will not dispute that at all.
Right. And so you're it's one of those things where you're doing a victory lap, assuming
I'm not doing a victory lap.
No,
I'm
all I'm
pushing
just
back to your
saying,
victory lap.
no, but all I'm saying is that your victory
I don't
lap
do
was
victory laps.
dependent. You just did.
No,
just
I
did.
did.
You
I
just did.
pushed back.
You totally
I
did, dude.
pushed back on your victory lap. I do not do victory laps. I am much too scared of the market gods to ever do a victory lap.
Well,
They frighten me. I'm scared shitless of them.
there you go. The bottom line, let's talk about this. We almost flattened the inversion, right? Like
Yeah.
the yield curve is basically back to zero, and the bull steep, because it's a bull steepening, and because the Fed is about to cut, this ain't going negative again. I think that this multi-year period where we spent a chunk of 2022, all of 2023, and a chunk of 2024 negative, I think it's over. Now, it doesn't mean that this is going to go screaming to 2%, but the negative inversion, I think that this is done now, and we're going to see a scenario where the bull steepening is going to continue, and you're going to see this, whether it's 25 basis points, 50 basis points, we're gonna go into positive territory, and it's going to stay there.
Aren't you making the case for you should own my position?
Again, for those of our listeners that can access the
No, but they can go
derivative.
trade TUA.
But
Go
the
do TUA and then versus. Now you can't do it versus TLT, and you have to duration match and stuff.
No, the TUA has already been levered 5-1.
No, but it's still not duration match to TLT. TLT's got a longer duration.
But the point I'm making, whether you like a thing is,
but like that's like saying like, okay, I can go buy FNGD, which is a triple levered, FANG index, and I would be much better off than just shorting the NASDAQ.
9 out of 10 of our listeners are literally in their ETF portfolios choosing between TUA and TLT. They're not levering it in any way.
They understand.
They're either buying one or the
10
other.
out of our listeners are sophisticated, well-rounded listeners. That
they are
understand,
sophisticated,
they
but they
understand
often
the
are
risk
not
and
using
the
the futures
positives and
market
negatives
like
of the
you.
different
Oh my
products.
God, whatever, dude.
Folks, I can't believe how Patrick's shitting all over
I'm
our
shitting
listeners.
on all the listeners.
I have faith that they understand the nuances between them.
All right. Breathe. Okay, now. All right, buddy.
I'm just kidding. Patrick loves you guys all. He actually is much better at putting up with everyone than I am.
There you go.
Yeah.
I'm pretty much done. I just wanted to touch on one thing. Gold has more or less been holding up, and so I just want to leave the last chart just touching on gold. it's still in a primary bull trend, higher highs, higher lows, primary. It's above all its moving averages. But the thing that I just want to highlight is that even though I remain big picture bullish gold, if and when the stock markets experience some volatility, uh, gold, like all risk assets, is often succumbs to correlation, and everything starts to correlate. I think that if you're long gold, this is a great time to carry the collars on it, because of the skew, and the contango and all of these different elements. You can carry a hedge wrap at a zero cost, if not even a positive credit, and you can more or less reduce the volatility. And I think that gold, Uh, you can always pull it. I know you're gonna give me your 1,000 ounces in a week, freaking rant. Come on, just give it. Yeah,
$1,000, not 1,000 ounces. $1,000 in a
$1,000,
week.
$1,000 a week. Come on, give me the rant quickly
No,
so
no,
that
I
we can
won't.
just get it out
Everyone
of the way.
knows the rand. Everyone knows it. Like everyone knows.
All I'm saying is reducing volatility here, I think is a good thing, because if we have a liquidity event that, let's say 3 months down the road, it doesn't have to be now, but and gold does what it did during COVID, which is a quick $200 an ounce wipe on the downside. It was just a big buying opportunity. And so if you are carrying some degree or another of a put hedge, it allows you to monetize and double down and take advantage of that gift that gold gave you, by the market volatility. And so I think carrying a hedge wrap on gold here makes sense. A lot of times you can be naked this, so that your special 1 day event, that you keep talking about, that you
No, it's
monetize it
1 week. 1 week.
1 week. Point is, I like the idea of being hedged in here, and I think collaring in gold here makes a whole lot of sense.
To learn more, go to bigpicturetrading.com.
Wanker. All right. All right, I'm done.
All
I'm
right.
done.
Okay, we're bringing back the questions, right?
Yeah,
Daniel is like, listening. He's like, we got to do something else.
yeah.
Where is
All
he?
right. Yeah, Daniel's gonna have to jump in here.
There
So
he is.
there he is. All right. So Danny, we got you. You want to bring this segment back, so you better
You have
spearhead
to
this, buddy.
ask us the questions.
Well, I think the thing is just I just felt that people were emailing in and we weren't responding to those.
That's true. If we're going to discontinue
What a bunch of
this, if we're
douchebags! We
going
just
to
ignore these.
dude.
We just ignore all these questions.
That's
Yeah,
right.
exactly. Okay, so this one's from David. I feel like the markets have continued to stray farther from their original purpose. The efficient distribution of capital towards companies that would be productive and succeed with that capital. I know Kevin likes to say that we should trade the market that we have, not the one that we wish we have. So I don't expect any actionable insight, but I am curious what the two of you would change about the markets in order to secure that integrity, or if you don't think anything needs to change, why? And that's from
That's a
David.
good question. Very broad based. Little heads up though. Tell us that. I guess I could have. You did tell us that the
You
questions
could,
were there.
you honestly could just load it up and read the questions in
Yeah, I
advance,
know.
Kev. You just didn't.
I didn't know it was going to be so philosophical though. Have you got an answer ready, Patrick?
No, I didn't.
Okay, I will take this.
All right.
What could I change? Well, first of all, one of the big things that I think that really went negative was the period in 2021 and before that, when all of a sudden we had promoters doing shit that should not be allowed. And I just go back to the 420 bids funding secured. It's an actual mockery of the stock market. And I still think, had he not gotten away with that, meaning Musk, tweeting something out that was obviously incorrect, obviously a lie. In our day and age, Patrick, in the 90s and the 2000s, people went to jail for way less than that. He got a little slap on the wrist, and I think it had opened up all sorts of just scandalous behavior, like with this guy rolling the truck down the hill, the EV truck or whatever it is. And I think it just made a mockery of the markets, and I think it made it much more of a game than it's ever been. And even like this thing about the idea that when there was this big short interest and that you could go and squeeze these companies. And although I do understand kind of the thinking, one of the problems is that if you go and think about what GameStop actually did in terms of when you had like the likes of Elon Musk and Chamath and all these guys encouraging people to invest in it, these in the long run, a lot of these stocks and a lot of these things, we know they're not going to work.
Yeah.
So we're basically going, we're going to play a game. We're going to try to squeeze everyone. And hopefully you get out before the next round. And all you have to do is look at Chamath. Like he's a perfect one. He went and did all these SPACs and he promoted the shit out of them. And at the time he was telling all these things. And then he had the audacity to a year later or 2 years later suggest to anyone, well, I sold. Why didn't you? You're a chump if you didn't sell. And I agree with this David here in terms of his worries that we have strayed farther away from the actual efficient allocation of capital, and it's become too much of a game. And I blame the SEC and the loosening of those rules.
I was literally going to touch on the GameStop as what I was going to reference, and I think it gives the markets a black eye. Like the fact that this idea that some guy's going to come onto Reddit and start whipping around stocks with millions of dollars. It's a blatant manipulation that is happening in plain sight.
Are you talking about the latest guy?
Kitty,
Because actually, I disagree with you there. I actually don't have any problems with Kitty. Kitty's got a view. He tells you what his view is, and he goes and does it. Like I feel like that's a free market. Where I have problems are when people that really should know better are encouraging people to invest and misleading the public. And so I think it's careful, because the last thing we want to do is start telling people, oh no, you can't trade this. Oh no, you know what it is. And like it's always that people talk about the suits. Like, oh, the suits are telling us this. The suits, like, or the Citadel, this is all rigged against them. And I'm like, no, actually, I don't actually think it is rigged against them. I don't think people understand that GameStop, when they halted it, it wasn't so Citadel could fix their positions. Like Citadel, that was a tiny little position in terms of their big behemoth. They were busy making money off of this. The fact that people thought, oh, I'm going to trade all sorts of options and I'm going to stick it to Citadel. Like the more options you trade, the better off Citadel is. That's just the long and short of it. Anyways, that's my 2 cents.
All right.
I think it's a careful line you have to walk, though.
All right. So let's do the next question.
Well, this one mentions Citadel, so I don't know whether they tie in together somewhere, but this one's from Derek. So why does the Fed make their announcements during market hours at 2 p.m. and the chairman gives his comments and answers questions at 2:30 p.m.? These are huge market moving events that only the Citadels of the world can profit from. Even the Mag 7 stocks give their results after the markets are closed, so that all investors have overnight to think about the market moving results. What's the difference?
Well, first of all, people are allowed to trade Mag 7 even like during the after hours. So it's not like they've halted the stock and then give everyone 12 hours to go think about it. Like they used to do that. I completely agree. And then the question is then, is it efficient for the Fed to announce it at 2 and then answer questions at 2:30?
So I have an opinion on this.
Okay.
Like the bottom line is what Derek is talking about is intraday volatility, like what would impact a day trader, and somehow suggesting that that Citadel can day trade better than they can because the news is being released. The reality is that investors, anyone with any reasonable time horizon, is not going to be impacted by the minutes that is being thing. In fact, I would argue in a liquid market that is absorbing that information, it's almost like right pricing the market for that information real time. The idea that this creates some sort of inefficiency by doing it during market hours, I don't agree with that.
I don't think that's what he's saying. I think he's saying it's not fair because let's say the Fed cuts unexpectedly, right?
It doesn't happen.
No, but let's just imagine it did. All of a sudden, it gets repriced instantly, and the faster the machines, they're able to take advantage of it, whereas the average Joe isn't. And so what Derek is arguing, I believe, is that you might be better off doing it at 5 o'clock. And all of a sudden, everyone gets a chance to digest the news. And listen, to some extent, this does happen on really important things. And that's why you'll find when there's big programs implemented in times of crisis, often the Fed does it on a weekend. And they do it on a weekend so that everyone can have time to think about it and process and things like that. So to his point, it does occur. I would kind of push back and say the reality is, even if you made it 5 o'clock or 6 o'clock, there's a market somewhere that's open. Someone's going to be allowed to trade. It's never going to be completely fair. So unless you're going to make the Fed work weekends, it's not going to work.
Right. All right. Let's do the last question.
Okay, so this is an anonymous. Absolutely love the podcast. Please keep doing what you're doing.
I wrote this.
Just wanted to get your thoughts on a possible macro scenario playing out. What are the chances that the foreign central banks will lower their rates while the Fed keeps rates high in the US? Would this cause the dollar on the Dixie to go up? How would this affect spot gold and treasury yields? Could we see the dollar near 114 again? Any effect this would have on equities? I noticed that when the dollar was around 114 and the S&P, was around 114, the S&P was near its low.
So, Kev, the interesting part that he's observing is, in some degree or another, the call you're making on the Canadian dollar, right? Which is that the situation will be far worse in Canada, and the Bank of Canada will have to cut rates far more than the U.S. on a relative basis, and the currency will be the outlet valve for the rate differentials. And I think that you're spot on that this can happen, but will it happen broadly across all countries? Because the Dixie is implying that the entire basket is going to happen rather than individual stories like it happening in Canada specifically. And this kind of stuff does potentially happen on a country by country basis, of course, right?
Yeah. So I guess his real question is, what are the chances that foreign central banks lower their rates while the Fed keeps rates high in the U.S.? I think that one of the things you need to always remember is it's not the absolute, it's the change in expectations that matters. So if we had a situation where the other countries started lowering their rates more than the U.S., then yes, it would affect it. And I guess another one of the problems I have is that everyone that thinks that FX rates are driven by interest rate differentials, I always say that those interest rate differentials are causal, like in terms of it's actually the difference in the economy, and it's not actually. So when we see Canada going down, everyone will be like, oh, it's because we lowered our rates, and I'll be like, no, it's going down because we lowering our rates because our economy sucks, right? And that's the part that's kind of complicated. And so embedded in that was a whole bunch of questions related specifically to the dollar and how that might affect the different assets. And that actually, it was almost too complicated to answer, because the reality is that there's all sorts of pushes and pulls that are occurring on so many different levels. And to your point, like you're saying, Canada specifically could be doing this, and then Japan could be doing this, and we could have the dollar, at different currents. The one thing I will say is that in times of stress, often the dollar will rise. And when the dollar rises, eventually what will occur is that the Fed has to go in and provide the liquidity to the world.
Yes.
And so one of the things, Patrick, I always give him a hard time because he always puts the dollar as the number one thing to watch. And he's not wrong, because at very important periods when the market is under a lot of stress, the dollar does end up being the most important thing, because credit contracts on a global basis, dollar rises, that causes more problems in the markets, and then eventually the Fed has to provide that liquidity, and the dollar will often be the signal that you can see in terms of whether that liquidity is being pushed out into the market.
Agreed. All right, Danny, where can people submit their questions that we ignore for weeks upon weeks?
Yeah, well, now that Danny's got us on the straight and narrow, we're going to do it.
Yeah, we're doing it. We're back. We're back.
So you can now submit your questions to nostupidquestions@themarketholder.com. I will answer them.
Oh, there you go. There you go. All right.
And the dog, what's the dog's name? Because he or she has a view.
There's two, unfortunately, but yeah.
All right. Give us an exit here.
All right. You guys know the drill. Thank you very much for tuning in. For those who have suffered through and watched us, I appreciate it. Danny and Patrick dragged me into this. Like they're both kind of slicker guys that look better on TV, and I was like pushing back against this, and finally I hit a point where I couldn't say no anymore, and I've agreed to be on YouTube. Hopefully you guys like it. Patrick, where can people find out more about you?
On X, you can find me at Patrick Serezna, and you can follow me at bigpicturetrading.com. Kev, where can they follow you, buddy?
You can go check me out at themacrotourist.com, and listen, bear market, bull market, we're just happy to spend some time together on this crazy ride. Stick around for the after show. All
right. I'm going to rate this beer.
Okay.
At first, actually, it started off like I was pretty good with it, but I'm finding it was rather more bitter than I expected. And
much like you're having to do a podcast with me.
Yeah, absolutely. But the other thing that I picked up on is that, okay, it's a 5.4%, so a little bit stronger alcohol, but it actually tastes like a 6-7% alcohol beer. Like you can taste that in there, and at 5.4, it shouldn't taste like it's a higher alcohol beer, because that's really down the center. Otherwise, it's a good beer, but I'm not going to give it an over-the-top score. I'm going to give it a 7.2.
Okay.
It's a clean drinking beer. It's okay. It's good.
Danny, are you drinking anything new, or are you just drinking?
I'm just drinking. I don't know if I'm allowed to put things on YouTube, but this is. I'm sure Patrick will know the shape of this bottle and what the brand is.
Yeah.
Yeah.
For those who don't know, Danny is taking over Patrick's place in Portugal.
Yeah, sorry.
Patrick leaves, and it's like, oh, Danny's like, oh, I know where I'm staying.
He's going to tap the Negroni barrel.
Yeah,
that's right. All right, so Patrick, we got this big weekend, this big market meetup planned.
Listen, it's been so long since I've been back to Toronto, and I'm looking forward to having a couple pints with you, buddy. And listen, we had to open it up. You know, we have so many amazing listeners and so many smart ones that know how to put on the highly leveraged long bond trade.
I want everyone to come up to Patrick and go, I understand how to do 210s, and I understand the difference between TUA and TLT.
I'm just gonna. Sorry,
Okay, and just a reminder, it's next Thursday.
It's Thursday. Right. This Thursday. There's only one Thursday coming up.
Okay,
it's just coming right now.
What's
Thursday,
the date?
the 15th.
Yeah,
7 p.m. It's by that the Railway Museum there, right across from the CN Tower.
It's called the Rec Room.
And we've had to piss up there before.
Yeah, it's Patrick's favorite place. He always picks this place, and I'm always like,
it's just big enough. It's big enough for a larger crowd.
Like it. It's got video games. It makes Patrick feel like he's 21 years old again and going out and doing stuff. It's kind of a weird choice, but it's Patrick. So whatever you do, don't make him feel self-conscious about it. Does anyone have anything new or exciting to share, or should we just call it a day?
I think we can call it. Buddy.
Okay, because you know what, my dog needs to be walked, and so does Daniel's.
There you go.
All right.
Great to be back in TO, buddy.
Good to see you. Looking forward to it. Make sure you guys come.